Well, markets are holding firm this week as investors double down on expectations of a Fed rate cut in the United States, while gold continues to trade above $4,100 an ounce, even after slight profit taking. Well, copper sentiment is increasingly split. It's being re-rated as a critical metal, yet analysts warn deflation risks could cap upside. Well, John in from Maison Placements joins us now. John, thanks very much indeed for your time.
Good to be here.
John, listen, markets are steady following the end of the US shutdown and growing rate cut expectations. Do you see this calm as the start of a longer recovery phase, or are we simply in a lull before volatility returns? What's your take?
Well, Devin, I just think that there's a lot of volatility lies ahead. And basically, when you look at the markets, we're awash with liquidity, and there are day-to-day events swatching into the markets. And there's been there's been a quiet period as far as economic news. So for the next few weeks, now that the government shutdown has ended, we are going to get a slew of economic news. And with each piece of news, there'll be will they raise rates or will they lower rates? And the consensus today is a lowering of rates. But the market is more than just the lowering of rates. I think that there's a confluence of very different factors. And I look back at history, Devin, and I think that we should look back. And I know that some people say we look at the 30s when there's comparable geopolitical events, etc. But I think you have to go back to the 20s. And my belief is that when I've done the research, we're just like the decade ahead, the roaring 20s, when you had sky high stock markets, sky high valuations. You had something new like electricity, or something even newer like cars and telephones and that. And that's comparable to the artificial intelligence today that's powering the market. So expectations are very, very high. Unfortunately, we know how, of course, the 20, how they ended, but then that's far off, hopefully, in the future. But so when I look at the markets right now, we have to look at the past, and I think that volatility will continue.
Yeah. Look, I want to see how gold and, for example, silver and other metals fits into this, right? Gold is holding above $4,100 an ounce, and Deutsche Bank just lifted its 2026 target to $4,450. John, do you see this as a structural repricing of the metal or a temporary trade on monetary easing? What's your take?
Well, Devin, I think the bandwagon is getting full. I mean, there's a lot more newer players jumping on, but similarly, there's a lot newer players that have been buying gold. We know the central banks have been buying for the last 3 years something like 25% of the world's supply. Well, we have retail demand, and on top of that, we also have something like Tether. Tether, the cryptocurrency, wants to be tied to gold. They have bought something like in the order of 100 tons, 116 tons of gold. That makes it larger than South Korea. So there are some new players that are coming to the market. The dilemma, or for a lot of players, is really how do I buy a lot of gold? And the world supply is limited. The gold producers, while they are feasting on the high gold price, the reality is that they are not bringing on new production. So when we look ahead, there's really a flat production profile to declining. Reserves are declining, and we're not finding gold fast enough. That's why these gold companies are making a lot of money and are now spreading the money, spending some of that in exploration. So I see a continuation of this bull market.
Yeah. Look, you look closely and precious metals have outperformed broader commodities. That's despite mixed economic data, John. Is this more about capital preservation, central bank buying, as you put it, or weakening confidence in traditional risk assets?
It's all of the above. The great thing about gold historically has been a store of value. And I've often said that it's a barometer of investor anxiety. Now, on the one hand, it's almost like a two-tier market. We have bullishness in the stock market, but that's really five big stocks, artificial intelligence. The rest of the stocks, there are some problems. Walmart reported good results, but only because they ate the tariffs. What's going to happen is that there is a consensus that preservation of capital, and historically gold has been that. If you look at gold and other currencies, it's done extremely well in addition to the US dollar. So my expectation is that gold, silver, that is the reason why they are precious. There's not enough of it.
Yeah. Look, given this backdrop that you speak about, right? Uncertain industrial metals, the shifting rate expectations, are you advising portfolios to adapt for 2025? How are you doing that? I mean, lean further into gold and royalty names, for example, take selective positions in base metal equities tied to strategic supply chains. Could that be one option?
The common refrain that I get is that, am I too late for the precious metal market? And the answer is no. I mean, for 20 years, gold had less than 2% of overall assets. It was abysmal low. And now it's probably double that to 4 to 5%. It's my expectation that gold, and I've seen it higher than 10% of global assets. And given the uncertainty, my expectation is that money will flow into the gold mining companies, the silver mining companies. And we've seen that in the past. So I don't see, given the very uncertain future, why that will propel an increase in gold assets.
Yeah. Listen, before I let you go, John, quick one. What are you watching about the dollar at the moment? I mean, anything making sense to you or peculiar about it at the moment?
Well, Devin, these are very uncertain times. So realistically, nothing makes sense. We can go look to the past for some clues to the future, but really, it's the great uncertainty in the U.S. is uncertainty. The only certainty is uncertainty. There is continuation of the tariffs. There's continuation of the fallout on the geopolitical front. There's a continuation of the money supply in the United States keeps on increasing, notwithstanding there's a call for even lower rates. In other words, more printing of money. The problem is that the Americans are now debt to GDP of more than 120 odd percent. That's trouble for most countries. So at a time when the Americans will need financing help, this might not come from their friends, typical previous investors like China, even Canadians. We are a big buyer of U.S. debt, but I've heard that investors are looking elsewhere rather than U.S., given the expectation that the dollar will go lower. So when we look at it, there's no question in my mind that precious metal prices are heading higher, led by gold.
Yep. Well, Johnny, we're going to have to leave it there. Thanks very much indeed, always, for your insights. We'll chat very soon.
Good to be here.